Our speaker is Eric Blake. Eric is a certified financial planner and the founder of Blake Wealth Management, specializing in helping women navigate retirement with confidence. With 25 years plus of experience, he provides clear, practical strategies that help women optimize their investments, create reliable income streams, and minimize taxes. His personal passion for helping women stems from being raised by a single mother and grandmother, being widowed at 62, providing a deep understanding of the financial challenges many women face later in life. As the host of the Simply Retirement podcast, Eric educates and empowers women to take control of their financial future. So, everyone, please welcome Eric Blake.
Thank you so much. I appreciate the opportunity. Thank you all for being here. Thank you to James for the invitation. And I'm going to start by asking you to think about a couple of questions. Have you ever looked at your retirement investments during a market downturn and wondered, should I be doing something? Or maybe you've asked yourself, am I taking too much risk? Or maybe even not enough? If you've had those thoughts, you are not alone. Investing can feel overwhelming. Retirement can feel overwhelming. Put those two together, and it is easy to understand why so many people worry about market downturns or whether they're going to have enough money to last. The good news is that a successful retirement investment strategy isn't about predicting the market or finding the perfect investment. It's about following a handful of timeless principles that can help you make better decisions over time. And that's exactly what I'm going to cover today. My goal is to keep this presentation simple, practical, and easy to understand, so you leave with 7 strategies you can use to make more informed investment decisions for retirement. Now, unfortunately, we always have these fun disclosures I got to share. So before we dive in, just a couple of housekeeping items. Everything we talk about today is meant to be general education. It's not personalized advice. This isn't specific investment advice. You want to make sure you talk with your financial professional who understands your specific situation before making any big decisions. Talk with your tax advisor if you have specific questions about the tax implications of some of the strategies we'll discuss. And lastly, I think James had mentioned this, we'll have time to answer questions, but we will hold those to the end. I always encourage you to share those now, put those in the Q&A as we go so you don't forget them. And then we'll get to as many of those questions as we can before we wrap up. So let's go and get started. And James has already shared some of this, but I just want to touch on it very quickly. Again, my name is Eric Blake. My firm, Blake Wealth Management, focuses on helping women over 55 who are divorced or widowed or navigating retirement on their own. I always say that's our specialty, but please don't worry. This presentation is going to be for everyone. If there are many men in the audience or couples tuning in together, I promise you're going to walk away with some practical, valuable strategies. And that focus on women comes from my own story. I was raised by a single mother. I spent a great deal of time with my grandmother, who was widowed at 62. She's now 91. She spent almost 30 years of her life as a widow. I actually have 5 generations of women in my family still alive. My granddaughter just turned 2.5. But it was watching my mother and my grandmother navigate life and money on their own that really shaped how I approach retirement planning. And it's why I'm so passionate about helping people feel more confident about their financial future, no matter what the background is. And because this is my presentation, I get to show you the 5 generations. So this is a picture of my grandmother, who is 91, my granddaughter, who's now 2.5. This picture's a couple of years old. But again, this is what drives me. This is my mother, my wife, my daughter, my granddaughter, my grandmother. Those are my why. That's why I do what I do. And obviously, everyone's situation is different, but most retirees are going to face a lot of the same big questions. That's what today is about. We're going to cover 7 strategies that give you a strong foundation for retirement, and also be sharing strategies and resources for navigating the more difficult periods of retirement, which are also certain to happen. Now, over the past few decades, retirement has changed a lot. When you think about back in the 80s and 90s, things looked, or at least felt, easier when it came to retirement. People had pensions, the stock and bond markets were strong, health insurance was solid, and Social Security had just been fixed with some new rules. And even government bonds paid, 8 to 9%, which meant you could take 4% out to live on and maybe have another 4% left for later years. But today's picture looks different. Most pensions are gone. Interest rates have been swinging up and down in ways we haven't really seen in several years. The stock market has had several big downturns since 2000, even though we've seen the positive results of the last few years. It doesn't mean we haven't seen our ups and downs in the past, including some of the worst downturns in history. And we've also dealt with significant inflation challenges, rising healthcare costs, and these ongoing worries again about Medicare and Social Security. But here is what I would call the key point. A successful retirement is still possible, and that's what the rest of this presentation is going to be all about. So strategy one is very simple, but is critically important, and that is you must have a plan. I would say the problem with the 24/7 news coverage that we all experience is that it incorrectly encourages you to focus exclusively on your portfolio or your investments rather than what really makes a difference in your life, and that is your financial plan. So the first thing I want you to think about is starting with defining your purpose. What matters most to you in retirement? I would even encourage you to ask what is most important in life when you're making financial decisions. The next thing is the plan itself. This is what I would call your roadmap. I want you to think this it's like a flight plan. It helps you move from where you're at today to where you want to go in the future in your retirement years. Then comes the portfolio. Your investments are not the plan. They are just the tools that help you carry out your plan. And I want you to think about it like this. Your retirement income plan or your financial plan is the flight path, and your portfolio is the plane that helps you get safely from point A to point B. You don't just hop on a plane and take off. If you don't know where you are or you don't know where you want to go, it makes it pretty tough to get anywhere. You also won't know when you need to make adjustments when you hit turbulence. Difficult markets, uncertainty, healthcare events. Every pilot starts with the perfect flight plan, but ultimately makes thousands of adjustments before arriving at that final destination. So to build a strong financial plan, you first need to answer some really important questions to define your purpose. Obviously, when would you like to retire? What do you picture yourself doing with your time? I will say, as someone who's helped a lot of people retire, this one may be just as important as anything else we talk about today about the financial side of retirement. It's how am I going to spend my days? You also want to think about what are the goals you have beyond just covering the basics of retirement. Why are these things important to you? And of course, finally, how much are these things going to cost? And your answers to these questions become the foundation of your financial plan. Now, strategy two, and this is really important, it's understanding the true objective of a retirement portfolio. And just a hint, it's probably not what you think. So, what is the objective of my retirement portfolio? Or more importantly, what should it be? So, whenever I ask a soon to be retiree what their number one fear in retirement is, of course, the most common answer is, I don't want to run out of money. And that sounds relatively straightforward, but there is a problem. When I ask many of those same individuals what the primary objective of their retirement portfolio is, this is the typical response: preserving my principal. And many retirees don't realize this, but these two statements are out of alignment, and I'll explain why. So, what's the problem with principal preservation? The problem is that people are living longer, and that changes how we should plan for retirement. So, for a non smoking couple retiring at the age of 62, the average life expectancy is about 92. That means there's a 50% chance at least one of those spouses will live 30 or more years in retirement. With a 3% inflation rate, which is about the historical average, that likely means prices could rise about 2.5 times over that 30 years. So, for some perspective, if you think about a box of Cheerios, that box of Cheerios you buy every morning for breakfast, if it costs you $5 today, that means it could cost you $12 or more by the end of retirement. And of course, we've seen the impact inflation has had over these last several years as well. So let's talk about what inflation actually is. I call it the silent budget killer. More recently, it maybe not so silent, but let's talk about what's happening here. Inflation reduces purchasing power, meaning that every dollar you spend buys less stuff every single year. And then it continues to compound over time. Even a 2 to 3% average inflation rate can devastate your savings over multiple decades in retirement. And there's also an uneven impact on retirees because many of the expenses of retirees, like healthcare, increase at a faster rate than just regular inflation. And if you want to see maybe the perfect example of inflation and how it can sneak up on you, postage is the perfect example. The cost of a stamp just 20 years ago was 39 cents. In 2026, it's 78 cents. That's the doubling of the cost of a stamp. That is inflation at work. So what's the real risk in retirement? It isn't losing money in the market. It is running out of purchasing power over time. A portfolio that merely preserves its nominal value while inflation rises is quietly shrinking in real terms. As an example, if I put my retirement savings in CDs at 3% because I think it's safe, but if inflation is 3%, I could still run out of money. And that doesn't even account for taxes, which we're going to get to as shortly as well. But think of it like like it being a slow leak in a tire that I didn't even know about until it was too late. Now I'm 300 miles away, I'm in the middle of nowhere, and there's not a gas station in sight. That's inflation. So what should the main objective of your retirement portfolio be? Many people think it's about protecting their money, but that's usually not enough. For many, the real goal of a successful retirement portfolio is growth of income, making sure your income increases over time so you can keep up with rising costs. So now let's talk about risk, because there is no doubt that investment risk can be scary. Again, because this is also what we see in the news. But in many cases, this fear is exacerbated by thinking about your retirement portfolio all wrong. So how can we reframe investment risk? Because many of us are used to what we would call the traditional view. In the traditional approach, portfolios are described by percentages, like 70% stocks and 30% fixed income, or 100% stocks or 50% stocks, whatever the case may be. But the focus is often on how much that portfolio might go down in a day, a month, or how much it might go down in a particular year. But just for example, a 70-30 portfolio, 70% stocks, 30% bonds, would have dropped about 24% in 2008. So if I started with $1 million, that means I now have $760,000, and that can be scary. And it often leads people to make decisions out of fear. But there is a better way to look at risk. And that is by focusing on years of income. So let's talk about how that works. Let's say you withdraw 4% of your portfolio each year, and you have 30% of your portfolio in bonds or fixed income. With 30% in fixed income, divide that by our 4% withdrawal rate. That's about 7.5 years of income set aside out of the stock market. And that buffer gives the stock portion of your portfolio time to recover during market downturns before you have to sell. So let's talk about why that's so important. So let's look at one of the toughest periods in recent history, and that is the Great Financial Crisis. For many of you who are on there today, it's likely still what you would consider the worst case scenario in your investing history. So October 2007, the markets reached its peak before the crisis began. By March 2009, the S&P 500 had fallen more than 50% from the peak. But then by March 2013, the market fully recovered to its previous levels. So just to refresh, market peak, market bottoms in 2009, full price recovery about 5.5 years later, 5.5 years after the peak, full market price recovery. During the second worst bear market in US history, the time from peak to full recovery was about 5.5 years, not including dividends. 5.5 years. So let's come back here. Talk about our slide on reframing risk. If the worst market downturn since the Great Depression took 5.5 years to recover, and again, for many that are on this presentation, that was worst case scenario and still may be. But in our example of having 7.5 years of income, that was enough to get us through it. Through what for many living today was the worst market of our lifetime. But if you had a big enough war chest, and that's what I call it for our clients, with a big enough war chest, we got through that. It was scary as hell. And there were times even I was worried in the middle of all this. But eventually we saw the light at the end of the tunnel, and we were able to make it through the other side. So there's a very simple question that guides how we set up our plan. How long would a market downturn have to last before you need to sell stocks to maintain your lifestyle. Our job is to balance your comfort level with what you need each month. That's where ultimately the rubber meets the road. And the answer to this question shapes your entire portfolio structure. So, will I choose a 5 year war chest? Maybe I'm a bit more aggressive. I only choose 3 years. Maybe I'm more conservative and I chose 10 years. But an example, 10 years was almost twice what we actually needed during the financial crisis. So if you choose a 10-year war chest, you might need to sacrifice or take a little bit less income from your portfolio as a trade off for more certainty during a difficult market. Whereas someone that chooses only 3 year war chest may have more income each month, but a higher possibility of needing to dip into that war chest during an extended market downturn. Neither's right or wrong. It's about what helps you sleep better at night. So now that we've reframed risk, how we think about risk, it's also a time to reframe how most investors look at stocks. And that gets us to strategy 4, which is understanding the role of stocks in a retirement portfolio. Now, quite honestly, many people see stocks just like gambling. That's why you see the picture of the slot machine, because that's how stocks can feel, especially if you're looking at it just on a single day basis, or if you're watching CNBC or some of these other news channels, where it's always about finding that next best thing, the next Apple or the next Nvidia, the next whatever, just hoping you hit it big by landing on red or getting triple sevens or whatever gambling you might like to do. And I honestly don't do any of it. But the history of the market actually tells a very different story. Over long periods, stocks have helped grow both income and principal. So they aren't just like gambling when you look at the decades of results. And on the next slide, we'll walk through a simple 30-year story to show you what this looks like. So again, let's look at a simple 30-year story. So if we look from 1996 to 2025, we can see why stocks are so important. So if I started with $1 million investment and I put 75% or $750,000 in the S&P 500 index and 25% in bonds, and just for a quick explanation, in case there's some younger investors or you're just really getting started, the S&P 500 would be a typical representation of the stock market. These are basically the largest 500 companies in our country, and you can't actually buy directly into the index, but you can buy a mutual fund or you can buy an exchange traded fund that invests in that index. So back to our example, we put 75% or $750,000 into the S&P 500 index, and then we put the rest in the bonds or more conservative investments. On just that $750,000, the dividends, the cash paid by the stocks, grew at about 5.7 times, roughly $17,000 a year to about $96,000 a year. And we'll talk about more about the importance of dividends here shortly. But the stock portion grew to about $8.4 million over that time. Now, keeping in mind, this means you're not actually taking money out, but this period also included 4 bear markets, including 2 of the worst in US history. So it's clear that as scary as bear markets can be, or that each one has been in the past, patience has been of much greater value. This is a clear case of doing nothing often being the right thing to do as compared to doing something when markets become volatile. So if you recall back from strategy 2, if the primary goal of a retirement portfolio is to provide a growing income that meets or exceeds inflation and to actually grow your principal if possible, a portfolio consisting of dividend paying stocks with our buffer, or what I call the war chest of lower risk assets for our years of income, is one way we may be able to accomplish this. Now, does this change, knowing this, does this change how you might think about investing your portfolio or how you might think about investing for retirement? So now that we've talked about the role of stocks, let's move to strategy 5, which is the value of dividend growth investing. So first, I just want to share a simple definition of what a dividend is. So if you buy a stock or you buy a stock fund in your 401k or your IRA, you become an owner of that company. If that company earns profits, it may share some of those profits with the owners as a dividend. So just as an example, even if you own even a single share of Apple stock, you own a small piece of Apple. When Apple makes money, it may pay you a dividend. If profits grow over time, that dividend may increase as well. So let's talk about what dividend growth investing is. So first thing, dividend growth is not trying to beat the market. It's not chasing the highest yield. And it's also not a guarantee fix for emotional investing mistakes. So if that's what it's not, let's talk about what it is. Dividend growth investing is a way to seek steady income that has historically outpaced inflation. It is a way to potentially leave your principal intact. And it's also going to be a simple system that reduces the stress of deciding what to sell and when because of that consistent income. So if we seek a reliable income that has comfortably outpaced inflation throughout history, dividend growth investing might be that solution. So this chart shows how dividends and inflation have changed over time. And again, dividends are the cash the companies pay their owners. Since 1960, prices or inflation have rose about 3%. But the cash dividend from the S&P 500 grew much faster than that. So dividend growth of the S&P 500 has grown about 42 times going back to 1960, while inflation has increased at about 11 times. So when we think about what that means for you, if your income can grow faster than prices, you have a better chance to keep your buying power in retirement. That is why we focus on dividend growth. Steady companies that can raise payouts over time, not just looking for the highest yield today. Now, of course, when it comes to investing, the idea is always about how do we achieve the highest return with the least amount of risk, right? So as we look at this chart, let's make sure we know what we're looking at. So the first thing is we have returns, and that's pretty obvious. It's the average annual return of companies with these different dividend strategies. The next column I want you to focus on is column 3, and that is standard deviation. Standard deviation is basically just a measure of volatility or a measure of risk. So for this period of time, from 1973 to 2025, companies that grew their dividends had the highest rate of return. They also experienced the lowest standard deviation or risk as compared to the other overall market. Now, companies that cut or eliminated dividends had lower returns and much bigger swings or volatility. So again, while dividends don't guarantee future results, they can be a sign of financially strong businesses. And that's one of the reasons why dividend growth investing can play a major role in our long-term investing strategy. The last thing on dividends before we move to our next strategy, and that is compounding. When you reinvest your dividends, you buy more shares. Next time you earn dividends on more shares, then it repeats. That's your money making more money over time. And you can see just looking at the price of stocks is only part of the picture. Ignoring the dividends can make a huge difference, as you see here, just simply by comparing the price only of the S&P 500 and the total return, including reinvested dividends, going back to 1960. Again, a huge impact on your end results. All right, so now we're on to strategy 6, and that is managing your taxes. In retirement, there's obviously more to consider than just investing. One particular area of importance is managing your tax burden. And there are a few taxes and what I would call phantom taxes that deserve our attention so that we can keep more of what we have and what we earn. There's something, depending on your age, that you may or may not be familiar with, but it's something called IRMA surcharges. And this is basically saying that if your income gets too high, your Medicare premiums can jump. Things like required distributions can push income up, so we plan ahead to try to avoid some of these surprises. Taxable accounts may also play a role in your tax strategy. If you want to keep taxes lower, you might be able to use ETFs or exchange traded funds or low turnover index funds or municipal bonds in your taxable account to keep your tax liability lower. We also have potentially Roth conversions. So in your lower tax years, you may think about moving some money from your traditional IRA account to your pre-tax accounts to a Roth or tax-free account to possibly reduce future required distributions and might also help you avoid those higher Medicare premiums or being pushed into a higher tax bracket in the future. And there are other tax strategies you might consider as well. And here are just a few examples, something I call filling up the tax brackets. So again, in your lower income years, you might choose to take a bit more from your IRAs, or as we talked about on the last slide, you might think about doing Roth conversions if you don't need that money yet. And this can give you more flexibility later on. There's also something called tax loss harvesting. So when we do see these market declines or market drops, you might consider selling some of your investments with losses to offset gains or even offset future gains. And that can also lower your tax bill. And then, of course, there's charitable giving optimization. Using what we call qualified charitable distributions or QCDs from your IRAs, if you are subject to required distributions, where you can send money directly to a charitable organization from your IRA and avoid paying taxes on those dollars. You might also think about gifting appreciated shares or appreciated investments, gifting those dollars to charities as a way of managing your tax burden as well. Again, managing your tax burden requires constant attention, but it can offer significant return on that time invested. And of course, we have the new tax law to discuss, and I've outlined some of the key provisions, some of the consideration strategy that might impact those of you who are joining us today. Something very important to keep in mind is that while some of these provisions are permanent, to whatever extent anything can be permanent when we're talking about politics, right? But many of these provisions that impact retirees and retirement planning are temporary. So just to go over a few of the key provisions, the tax brackets, the lower 2017 Tax Cuts and Jobs Act brackets are staying in place permanently for now, however long that might be. We also have the new age 65 plus deduction. This is a new $6,000 deduction. Again, it's only from 2025 to 2028. If you're over 65, by the end of the calendar year, you may be eligible for this, but there's also phase outs. I talked about some of the income limitations or income tax strategies related to income earlier on filling up the bracket. There are phase outs on this age 65 plus deduction where at 75,000 in adjusted gross income for single filers, it starts to phase out, and $150,000 for married filers, that deduction starts to phase out. Now, I also want to touch on Social Security. As many of you probably have figured out by now, benefits are not tax-free. However, with this new 65 plus deduction, the statistics are that up to 90% of recipients may not owe tax on their Social Security benefits, but it's because of that deduction, not because the Social Security tax rule is changing. There's also something important called the SALT cap, the state and local tax deduction, where the cap on that was significantly increased, again, temporarily, where in 2026, that cap is 40,400, but then it's going to drop back to 10,000 in 2030. So for higher tax states where you got like New York, where you've got a state income tax, or you've got higher property taxes, that can play a significant role in your tax situation as well, where you can deduct up to $40,400 in 2026 on those different taxes. So again, let's talk about some of the opportunities that come with this new tax law. So again, as I said, it extended these lower brackets, which may help reduce taxes on your IRA and 401k withdrawals. It also potentially creates a window for larger Roth conversions at these historically low rates. Also, the opportunity to optimize income before your required distributions start, either at age 73 if you're born in 1960 or later, or 75 if you're born in 1960 or later, 73 if you're born before 1960. That is your R&D age. And again, also QCDs or qualified charitable distributions remain a very viable strategy. And there's also a new deduction for if you're not itemizing your taxes, there's a new deduction for charitable donations of up to $2,000 for married couples and up to $1,000 for individuals starting in this year of 2026. So if you're making charitable donations and you're not itemizing, you may be able to deduct up to $2,000 for married, $1,000 for single. Which brings us to our final strategy, strategy 7. And this is more of what I would call a question. And that is, should you work with an advisor? Obviously, my bias on this topic is probably obvious, but also as you have probably figured out by now, retirement income planning is much more complex than accumulation planning. Beyond the investing and tax-related decisions noted throughout the presentation, there are many more important decisions that need to be made regarding Social Security or Medicare, estate planning, long-term care. All these require your attention, and an advisor can help you put those pieces together to make a clear plan, help you stay calm when markets get bumpy, but also continue to provide continuity for your spouse or your family if you're the main decision maker. And on the next slide, I want to share what professional guidance can look like and the kind of help many families find most useful. So here's what professional guidance can add. Number one is experience. A seasoned team looks across investments, taxes, Social Security, Medicare, estate planning, and long term care. So all those pieces fit together. You also have objectivity. When those markets get noisy, you should get calm, evidence based advice to avoid making emotional decisions during those periods of time. And again, continuity. If you're the main decision maker today, a trusted partner can support your spouse or family if they ever need help later. And of course, the big idea here is that steady guidance helps you stick with the plan when it matters most, which again, in retirement, in those years where it's really critical, where that risk of running out of money becomes so top of mind, that's where it can really make a difference. Now, that said, deciding who to partner with for your retirement journey is an important decision. So I'd like to offer just a few questions worth asking any potential candidates that you might think about hiring. Question one is, are you a fiduciary? Meaning, do you act in the client's best interest at all times? Number two, what services do you provide? In other words, what else do you do beyond just managing my investments? Number three, what would a typical year of client service look like and feel like? How often would we meet? When are you available? What is your communication strategy? And of course, number four, what are your philosophies around creating an effective retirement income strategy? Now, candidly, you might rightly believe that you can manage your own financial affairs in retirement. The question becomes, do you want to commit the time and the energy to design strategies for a successful retirement? Or would you prefer to partner with an advisor who can walk with you every step of the way? Of course, that is your choice. So where do we go from here? Just to quickly recap our 7 strategies that we've covered today. Number one is have a plan, because your plan guides everything. The portfolio is the tool, not the plan. Number two, we talked about understanding the true objective of a retirement portfolio. You should aim for growth of income, not simply preserving principal. Number three is reframing risk. Think in years of income instead of percentages. How many years do you need in your war chest? Number four, understand the role of stocks. Use stocks for long-term growth and rising income, even with the ups and downs that come along with that. Number five was the value of dividend growth, seeking steady income that can outpace inflation. 6, managing taxes. You just simply want to use tax smart moves to lower your lifetime tax liability. The less you pay in taxes, the more you get to keep and the more you get to spend, or the more you get to pass on to the people you care about. And then number 7 is consider an advisor. Get experienced guidance to tie all the pieces together. These 7 strategies are timeless, but what makes them powerful is how you apply them in your own situation. And that's where your next step comes in. So now that we've walked through the 7 essential strategies for successful investing for retirement, let's talk about how you can move forward from today. Here are 4 simple steps that you can take. Number 1, again, potentially seek professional guidance. Talk with a trusted financial planner or retirement coach. I know that James mentioned some resources they offer as well. Number 2, develop your plan. Write down your goals, what your income needs are, and how your savings is going to support those. Number 3, and this is really critical, implement your strategy. Put the plan to work. Set up your accounts, automate your savings, and organize your investments and taxes. And then number 4, review and adjust. Check in regularly. We know life is going to change. Your plan should adjust with that. I mentioned earlier that a pilot will make thousands of adjustments before reaching the destination. You start with a plan, but it's only as good as your ability to adjust over time. And I don't know about you, but I don't rate my pilots on their ability to write a flight plan. I rate them on, did they adjust throughout the flight and did they get me to my destination? And this is your reminder to take action. The best time to start for many of you may have been many years ago. That may even be a source of worry or concern, but the second best time to start is today. You don't need a perfect plan to begin. Take one small step, check your spending plan, set aside a few months of cash needs, or schedule time to review your investments or your taxes. These small steps will add up. very quickly. Starting now gives your plan more time to work for you. If you have questions or you need any type of help, resources to help with your plan, I'm always happy to be a resource for that. We've got a podcast, we've got a YouTube channel, anything I can do to be a resource. Free, we've got tons of free tools and resources on our website, whether it's the Blake Wealth Management, BlakeWealthManagement.com or the SimplyRetirementPodcast.com, where we've got a ton of free resources. And of course, the podcast is free as well. So these are all just some resources that might help you. Feel free to reach out, shoot me an email if I can address any of your questions or steer you in the right direction as well. But thank you for your time and attention today. I know we covered a lot about investing for a successful retirement. The most important step is simply to start. Think about your money, your lifestyle goals, your healthcare needs as you're planning. These ideas give you a starting point, but everyone is different. So work with your financial, tax, and legal professionals to build a plan that fits you. And I'm wishing you confidence, freedom, and fulfillment in the next chapter of life. All right, James, if you want to hop back on, we can try to get to some questions if we have time.
Yes, we have plenty of time. There's only 5 questions so far. The first question, as an almost 70 years old conservative senior, is that 20 in stock and 80% in bonds for a portfolio okay?
So I'm not a huge fan of always basing any particular allocation based simply on age. You'd want to look at a couple of factors. Obviously, even if you're approaching 70, that still means you might have not knowing any particular health issues here. Even approaching 70, that might mean you have another 20, 25 years left in retirement. So that's my point with being too conservative. That might be as risky as being too aggressive. And so I would base it on how much income do I need from my portfolio? And then be able to structure my portfolio around that. I talked about the war chest. So, if you're a more conservative investor and you say, hey, financial crisis was 5.5 years, I'd really feel better about having a 10-year war chest. Again, not making any advice or making any recommendations, but a 10-year war chest might result in like a 50-50 allocation. So again, not saying that's right for this person, but you would want to understand what your income needs or how much income do you need from your portfolio as compared to other sources that you might have, whether that be Social Security or a pension or whatever other sources of income, and use that to balance out your income strategy and then guide your decisions about how you should be investing your money.
Okay. Next question. If a retirement portfolio consists of both a traditional IRA and a Roth IRA, does the investment strategy differ for each portfolio? For example, would they both be structured for growth? Or does it make sense to have the same asset allocation in each, or would one benefit more from greater diversification?
I love this question. This is a great question. So again, in some way, it's always going to be dependent on the individual themselves. But in thinking about what tax rate am I at today versus tax rate I might be down the road. And one of the things I talk to clients about is at some point in the future, I don't know when it's going to be, but you're going to call me and you're going to say, I need $50,000. I need $100,000, whatever that number is. It's a big number. Now I tell them, I hope it's for something great. I hope you're taking the family for a trip around the world, whatever it might be. But it might not be. It might be something more urgent. It might be a healthcare need, an emergency healthcare need. But when that day comes and you call me and say, I need $100,000, where is it going to come from? It might come from an IRA. It might come from a Roth. Now, again, it depends on how much you've got in each of those buckets. But oftentimes, if Roth IRA money, just in general rule of thumb terms, Roth IRA money is usually that last bucket of dollars that we're going to turn to because of the tax implications. So if that applies to you, it might be a situation where if we're drawing more income today from traditional accounts, that might result in us being a little more conservative, whereas the Roth IRA money might be a little more aggressive because we assume that it's not going to be needed for 10, 15, 20 years from now. So that would be an example of where you might structure your portfolio differently based on the source of dollars, where the IRA might be a little bit more conservative. Now, when I say conservative, again, it's all relative. That might still mean if you've got a 5-year war chest, that's like a 70-30 allocation versus, if you really felt comfortable with it, a 90-10 allocation for your Roth. Again, not specific advice or recommendations, but just an example. Or it might be a 50-50 allocation for your IRA because you're drawing money today versus a 70-30 for your Roth. Because again, that's money that might not be needed for 10, 15, 20 years. So take time frame into consideration as you're structuring your portfolio, and what source of income do I need today? Where's my money coming from today versus where it might be coming from for 10, 15, 20 years from now?
Okay, our next question. Do you have any advice for already retired senior women, such as info issues or regulations?
I can't give you any specific advice. Be educated. There are a ton of great resources out there. Again, I've got a podcast that's 100% free where I talk about Social Security and tax planning and a lot of these different concepts, even going beyond just the traditional financial stuff like the impact of caregiving, those types of things. So look for resources that are out there and to educate yourself. There are a lot of free resources. I'm sure, James, you guys offer. It sounds like you guys offer some different things that are available.
Yes.
There's organizations like, I don't know if it's okay. Can I mention the Savvy Ladies thing?
Yeah, oh yeah, absolutely.
Yeah. So there's a group called Savvy Ladies who provides free financial coaching for women that if you just, sometimes it's just, I don't know where to start. So that's a great place to start where it's not going to cost you anything. You hop on for an hour with somebody who's got the experience to give you some direction and okay, here's what your next steps are. So that's the biggest thing I would encourage you to do is educate yourself, find resources, and there's a lot of free resources out there these days.
I just dropped the link for Savvy Ladies website in
Awesome.
the chat
Awesome.
box. Yep. Next question. If you make a trust, does Medicare not know your true assets and therefore will not increase your premium?
Not necessarily, because again, it's the tricky part about Medicare premiums, and again, referring back to that slide I had on IRMA surcharge. So it's income related monthly adjustment amount. It's what the IRMA stands for. So Aunt Irma and Uncle Sam, right? So what that means is your income, and I'll use an example. So your income in 2026, your tax return in 2026 will determine your Medicare premium in 2028. So it's 2 years behind. Or another way to look at it is your premium this year. If you're on Medicare in 2026, your premium is determined by what your tax return said in 2024. So it does take some advanced planning. So now when you say, well, can a trust basically hide income? And one, it really depends on what the trust is. Because it's not like a Medicaid situation where you're trying to put your assets in a trust in order to qualify for Medicaid. That's a whole different issue and a whole different conversation. But if you still receive all the same income simply because you opened up a trust, a revocable living trust, all that's doing is really helping me avoid or minimize the impact of probate. It doesn't change my income situation at all. So my income would still be the same. So if my income in 2026 is high enough to push me above those IRMA thresholds, I'm going to pay a higher Medicare premium in 2028. Now, there are certain life events that might qualify for you to have a waiver of that. Loss of a spouse, loss of income, which is another fancy way for saying retirement. There's 8 total that potentially allow you to qualify or request a waiver of that additional premium. Now, what I will share with you and something that catches way too many people by surprise is selling an asset is not one of those. Meaning that, these days with real estate values being as high as they have been, if you've got, a house that's appreciated, you bought it for $100,000 and now it's worth $1 million, and your gain is more than the primary residence exception and you result in a capital gain, if that capital gain is high enough, it's going to cause you to pay higher Medicare premiums for at least that year. So those are all the advanced planning things you got to think about. And again, sometimes where it's worth potentially consulting with a financial planner.
Okay, next question. Are there mutual funds and ETFs for dividend growth investing, and how do I find them?
There absolutely are. That's where there's a number of great resources. Morningstar's out there, even Google Finance, some of those websites. And I wouldn't necessarily, again, the point of the one of the slides was thinking about what dividend investing is versus what it's not. You're not necessarily looking for the highest yield, trying to find the highest yield portfolio, but you're wanting to incorporate dividend growth into my investment strategy. But there are ways where you can filter. There's ETF.com, I think it is. There's a number of different websites out there where you can do this kind of research and you're just looking for, if you really just focus on dividend paying funds, that's easy enough to find. It might be as simple as you're looking for value funds. That can be, sometimes, a lot of times paying stock, high dividend paying stocks might fall in the value category. But there's a lot of resources out there Again, things like Morningstar, ETF.com, even some of the personal finance websites, the Yahoos, have a lot of search capabilities where you can kind of filter for what you might be looking for specifically.
The library offers Morningstar for
Awesome.
anyone who has a library
Okay.
card with us. You can access it
Perfect.
remotely with your library card as long as you're in the state of New York. The next question: does life insurance with LTC help your finances?
So I'm going to go with the assumption that you're talking about a life insurance policy with a long-term care benefit or long-term care rider attached to it. To say whether or not it helps your finances, I'd have to know a little bit more about the situation. But the basic concept is you have a cash value or permanent life insurance policy that has a long-term care rider where it's going to pay some benefit if you qualify for a long-term care event, meaning there's what are called these activities of daily living. And so typically it is there's 2 out of the 6, it's like bathing yourself, feeding yourself, mobility, those types of things. So if there's 2 of the 6 you can't do, you might qualify for a benefit or for this rider to kick in a payment to you to help with covering those costs. So there's a lot of factors that go into that. I would always encourage you to consult with a specialist when it comes to those type of policies. There's a lot of great resources out there, a lot of great people that and be more than happy to connect you to somebody if that's something that you're it's not something I do personally. We have those conversations, but I'm not a. There's too much to know to feel like I can be an expert in everything. But so they can be good, but that's you'd want to know that's why you're getting into this is to help you cover those types of costs. And depending on what other resources and other income you have, that might be able to help you with that as well.
Okay. Next question. A few questions actually just dropped in at the last second.
Okay.
Next question. For someone just starting off in their career, will an index fund be a good option for long-term investing? And where do you recommend people getting started with your research process for long-term low maintenance investing?
I think the same thing. So again, depends on whether you're trying to do this on your own. And there's again nothing wrong with that, but you want to take the time first and make sure you educate yourself and looking for, what's my risk tolerance? What are my goals? What's the money for? That would be all those again, starting with your plan. What does my financial plan look like? What am I trying to accomplish financially before we ever get to what type of investment strategy I need? So again, if you're newly to investing, but you tell me that I'm going to buy a house in 5 years and that's my primary goal, an index fund probably is not the right solution. But if it's, hey, I've already got my house, I am really focused on retirement, 20 or 30 or 40 years from now, an index fund might be the right thing. Now, again, index fund is a general term because you've got large companies, you've got small companies, you've got international, all those types of asset classes to think about in how you start to build your portfolio. Or do you look at something that's just a what's called an asset allocation option? You hear that these target date funds that have the XYZ 2055 fund or those types of things that might be an easier approach depending on where you're at in your journey, your education journey, and understanding how these investment concepts work. But I would always encourage you first to start with your plan. What am I doing? What am I trying to accomplish financially? And then your portfolio comes next after that. But again, Morningstar is a great place to research some of these options. Podcasts, there's a lot of great podcasts out there. Again, having a podcast, I'm a big podcast fan. There's a ton of great podcasts out there for new investors or people who are new on their financial journey. I would definitely encourage you to start with something like that.
Okay, we had a follow-up to the earlier question about life insurance. They clarified
You broke up for a second today.
cash value from life insurance related to Medicare. Um, sorry.
Again,
Yeah, I'm breaking up. I'm sorry.
I got you back. You're good.
Okay, sorry. So the person with the question about Medicare insurance earlier clarified they're asking about the cash value from life insurance related to Medicare.
So there's any number of ways that they might be thinking about this question. So if you're talking about cash value from life insurance as an income source, where you're borrowing against the cash value to help cover some of your income needs, that's not going to show up on your tax return. in which case it wouldn't impact your Medicare premiums. It's not going to show up. So basically, your Medicare premium is determined by your adjusted gross income. So if your adjusted gross income or what's called modified adjusted gross income is above certain threshold, that's where it could trigger those higher Medicare premiums. So if you're talking about a cash value policy where you're borrowing against the cash value, that doesn't show up on your tax return. Now, there's obviously other kind of risks and all things that go along with it, understanding the contract that you've got. That's a whole, again, another conversation. But as far as saying if that's what you're referring to, taking loans out against the or surrendering basis of a life insurance policy wouldn't go on your tax return, so it wouldn't impact those Medicare premiums. So I'm going to have to go with that being the question, the assumption of what the question being asked is.
Okay. We have one last question. Someone asked, do you have offices in the New York City area, or would a meeting be done over Zoom?
It would be Zoom. So our office is there. We're actually here in McKinney, Texas, which is a little bit north of downtown Dallas. But we've got clients all over the country. So if that's something somebody be interested in, and
Okay.
yeah, for us, it would be for working with somebody in New York, it would be by Zoom.
Okay. Someone asked if you could show your contact information one last time.
Yeah, absolutely.
Yep. Excellent. That was the final question. Oh, wait a second. Let me check. Oh, there's one last question just dropped in. Sorry.
Sure.
Someone asked, there are some YouTube content creators talking about retiring at 62 years instead of 67 years. Can you talk about this?
So it depends on when you say retiring versus the decision around Social Security. I guess that would be the clarifying point we would need to find out. Anytime you, so actually that's the decision in itself of saying, okay, if I'm retired, do I start Social Security at 62 or do I start at 67? And that's again very individualized and understanding what your financial circumstances are versus actually retiring at 62 or 67. So if we're talking about, that the Social Security decision, that's a whole nother conversation that we'd want to get into and saying, actually, if I'm starting at 62, I'm getting a significantly reduced benefit, but I'm getting it sooner. But if I live into my 80s or 90s, I might come out ahead by waiting. And my total lifetime income might be greater if I were to have waited till 67 or even 70. So just to be clear on the Social Security rules, earliest retirement age or filing age is 62. For most people these days, full retirement age is 67. That's when you can draw your full benefit. But you can also choose to delay until 70, in which case your benefit grows by about 8% per year, maxing out at age 70. So that's the latest you would wait.
Yes, they clarified they were asking about Social Security.
Yeah. So a lot of people on YouTube say a lot of things. So I can't speak to and most of the time the argument is you're losing out on 5 years of income, which I guess technically you can make that argument. But again, with the longevity slide I showed earlier about saying, okay, if I retire at 62, especially if we're talking to married couples, there's a pretty good chance one or the other is going to live until 92. So that's 30 years. If you live till 92 and you started Social Security at 62, you're giving up a ton of lifetime income by doing that. Again, doesn't make it necessarily right or wrong for your situation because I don't know your situation. But if you retire at 62 and you don't start Social Security, you also have to have other resources to live on. So do I have investment assets or retirement assets or a pension or part-time work or whatever that might be? So all those things, I'm a big believer that your retirement decision is not simply based on age. And in fact, we have an entire email series that I built out on that exact topic of what else should I consider besides simply age when I'm making my Social Security decision. And also just to point out that because of our practice focusing primarily on women, you also have to consider in many cases the women have historically had lower earnings or less earning years simply because they may have stayed at home with the kids or they may be taking care of parents these days. That's such a frequent issue where our aging parents need somebody to help care for them. So that's where, if the husband has the higher Social Security benefit as compared to the wife, and the husband decides to start at 62, not only is he getting less income by doing so, he's now also reduced her survivor benefit. So that's something that I am a very big believer in. I think the woman should make the decision, quite honestly, if you're asking me, at least be part of the conversation, if nothing else, when that decision is made to start at 62 or 67 or even 7.
Okay, that was the last question. So if there's no further questions, that's the end of today's presentation. So thank you, Eric, for this webinar.
Awesome. Thank you, James. I appreciate the opportunity.
Thank you everyone for attending. As I said up top, I will send a follow-up email within 24 hours, which will include transcripts of the chat box, the Q&A box, a document within my PR resources, the slides of today's presentation, and a link to a recording of this webinar, which will be viewable for 30 days, but it cannot be downloaded. So again, that's the end of today's webinar. Thank you everyone for attending, and please have a great rest of your day. Take care, everyone.
Thank you, guys.